Intelligence, and Vladimir Langhammer, MD of Supply and Trading at OMV. And we are hoping to be joined, hopefully later, by Rustin Edwards from Euronav, if he can join us for the last 10 minutes or so of the program. Good morning, gentlemen. Midweek here, lots going on in the markets, lots going on geopolitically. We have Mr. Xi and Mr. Biden having friendly chats, and of course finished off COP26 last week, and the market sort of back focusing on trade. Mike, let's start with you. Would you agree? I mean, you've been quite bearish all year in terms of a medium long-term outlook, but is the market getting clear enough signals today? We have an article there which is saying there's some concern. There's very mixed signals. You know, you've got resurgent COVID concerns creeping in Europe and currently still existing elsewhere, and yet inventories are being drawn quite healthily. So how's the market meant to interpret this going forward?
So I think the most significant for me is I look at it as a trader who's been stopped out. What does that mean? Prices have gone higher than expected, but if you look at the price, the advance in crude oil since the end of 2019, right before COVID, it's up less than U.S. money supply. Money supply is up 40%, crude oil's up 30%. It's divergent weakness. And compared to commodities and stocks, most of the broad commodities, crude oil is actually underperforming. That's what I fully expect and fully expect to kick in next year. So I think prices have gone higher than I expected. It's going to bring on supply more than expected. And I see that in all the data. U.S. is going to return to a net exporter of crude oil and liquid fuels next year. We're going to have an excess of supply. And demand has been flat and is actually starting to decline. Now, I focus on the U.S. because that's been the main driver of lower prices for the last 10 years. I think it's going to kick in next year, and I see WTI heading closer towards 50. I believe the forward curve now, D's contract for 2022 has been stuck around $70 a barrel. Now we've had that. The curve is actually kind of inverted, not inverted, but it's released some of that backwardation a little bit. But I fully expect that to kick in, and the same problems we had before COVID to resume, and that is excess supply in the U.S. The average cost of production in the U.S. is now $37 a barrel. There's a lot of incentives. So to me, that's the case. And I'll end with this. It's a simplistic, higher price cure. It's happened in soybeans. It's happened in corn, in lumber, in copper. And crude oil has just been actually one of the worst performers in the big picture. And I think it's going to roll back over in the big picture and head down towards the longer term enduring trend for commodities, which is the higher price cure. And we had a great cure this year. Supply comes on. Demand elasticity is also a factor.
Okay, I mean, supply comes on of crude, and maybe that by the laws of economics should pull prices down. But all the other commodities are kind of continuing to have a pretty bullish year or two, supply chain issues, etc., different things. And many argue that crude is still way behind as a commodity. And you've got also trading houses like Vito and Trafigura saying that they're going to remain very well supported into next year, possibly hitting the $100 mark. So how do you explain, Mike, their thinking? I mean, are they just pushing their own books, or is there a possibility that oil will be carried along with other commodities?
Sold to you. I show peaks in corn, peaks in copper, peaks in lumber, peaks in aluminum. You name it down the list, and those are more the less elastic. Well, I guess corn, the grains are the most elastic. So I think, yes, they're talking their books, but commodity people are trained to be bullish. And I guess I'm a little more jaded by, I see these massive increases in advancing technology being able to bring on supply a lot easier than any time in the past. Most notably I come back from a grain background, in GPS and advanced seeds, no problem. In crude oil, just look at U.S. shale and Canadian, just U.S. and Canada alone. And then we also go over to OPEC. Unprecedented discipline is not going to last longer. And then we have this election coming up. So to me, it's a macroeconomic supply demand elasticity is going to do what it's been doing, most notably for the last 10 years. And it's already showed up in many commodities. That's what I point out. To me, the most elastic are the grains, and they peaked this year and they're going back down to cost of production.
Okay, Vladimir, good morning again. Let's talk a little bit about demand. You're sitting in the UK, no longer in the heart of Europe, but somewhat linked. And of course, we are seeing some concerns there in Europe on the COVID front in terms of where that's going again, the fourth wave, lockdowns, possibly not. into 2022. But let's look at the demand picture. That, where you see that going for products, for example, jet had a nice resurgence a month ago. Where are those products going in 2022 as far as the market's concerned?
Yeah, good morning. I think the demand is quite healthy, and it remains so. Yes, you have kind of the resurgence of the lockdowns or restrictions, let's put it like that, because I think the lockdown, compared to what we've seen in 2020, it's certainly much less in terms of mobility and everything else. As you said, jet is coming back, but it was a big laggard in 2020. I mean, margins are remaining quite strong. That's not only Europe, but it's obviously Asia. I think also in Asia, yes, you will see some kind of resurgence, but I don't expect the lockdowns as we've seen last year, because they're just damaging the economy so much. China had, local lockdowns, which kind of spooked the markets from time to time. But when you looked into the numbers, I mean, they had 100, 200 people here, 1,000 maybe, but, and they're able to contain it very, very quickly. So I think the demand will continue to rise. I mean, it has been actually quite strong in especially second half 21. As I said, the laggard was jet. That's coming back now with the intercontinental flights. Yeah, you might have, you might say maybe that is going to be cancelled at one point again, but I don't think so. So I'm quite bullish on the demand side.
Yeah, I mean, of course, we had that recovery in the second half of this year, and from a lower base, right? I'm recovering from COVID at the end of the day. Let's talk a bit, just Vladimir, to stick with you on the gas situation in Europe. We had Germany, the Nord Stream 2 pipeline project, sort of incurring a bit of a delay with Germany, not giving approval because of sort of legal contractual matters, possibly other geopolitical reasons. But no, Germany wants that gas, obviously. And so what impact is that going to have on the sentiment in Europe for gas supplies in the winter coming up?
I'm not a gas trader, but obviously I think every crude trader and product trader has become a little bit of a gas trader in the last 2 months, especially in Europe. I don't, my personal view is it's not a problem of capacity.
What about the fact that, as you said, crude traders have become gas traders because of the impact on crude prices? So is the sentiment in the crude products market that gas will continue to push those up?
I mean, we've seen it. The high gas prices have spillover effect into oil prices. I think the mechanism is not so straightforward, but high gas prices in Europe will increase LNG, and that will increase prices LNG globally, and that does encourage some switching to crude. I mean, if you look at those prices still, I mean, gas is way above the $82 a barrel equivalent. So I think as long as gas can have a very elevated levels, not only in Europe but globally, it will have a supporting factor into the demand of oil products and oil.
And let's just okay. And China. Let's talk a little bit about China, Vladimir, in terms of demand, as we're on the demand question here, that you said is looking still fairly healthy, fairly strong into next year. In terms of the demand coming from China, and the economic outlook for the country, it's just told its coal suppliers more than once to just keep producing as much as they can. October coal, I think, production rose to 6-year monthly highs, etc. It needs more. It's not getting it. Where do you see that demand picture going in terms of the pull on crude and products, well, crude mostly, and gas into the country next year? I mean, is China enough of a big support again for this market? It rescued the market in 2020. Is it going to be the same, lending the same strength next year?
I think for me, the question is if the market will need to be rescued. I think the demand is growing elsewhere. Also in US, yes, it is impacted by the high gas prices, absolutely. But we still see, draws in some of the inventories. The product inventories are record low. So I can't see why China should slowed down significantly. Again, a lot of the, I mean, people in China are buying diesel generators to generate either heat or electricity. So that has an impact despite the coal. Yes, it will come back, and yes, it will replace some of that oil demand. But I think once the gas price is going to abate, then it's going to be coal that goes first rather than oil. So again, I don't really see that China needs to be the white knight again.
Mike, let's talk a little bit about the macro US picture, well, global picture. You've got President Xi, obviously, and President Biden having had their call this week, all nicey friendly, let's work for the best of everybody. One thing that Biden asked Xi was to release some oil reserves of its own, obviously, to calm markets down generally. He's kind of failing on his front, isn't he? Still holding out that this SPR release may happen, and a lot of the market's dismissing its impact.
I think the market is smart enough to know that's not a smart thing for Biden to do. The last time there was a major release was 2011. That was an IEA coordinated. Now there's been releases for hurricanes, but this is, if he just, my advice is just let markets, free markets reign, let the U.S. drill at will, and we will see WTI closer to 50 by the time he gets to the midterm elections, which is kind of his focus. There's a key thing to really focus on here. The average cost of production for U.S. gas and U.S. crude oil is about half of it was 5-6 years ago. So I have to focus on gas a little bit because we just talked about gas. The average cost for MMBtu in the U.S. is less than $2. 2014, the last time we reached $6, it was almost $4. It's about $3. So that's just not good for prices, and that's been the trend for the last 10 years. So for Biden's standpoint, it's purely political, and the market's already starting to, I think, ignore it as political rhetoric. And then it's starting to realize, well, okay, he needs lower prices. The best way for that to happen is just to lighten up on some of the restrictions on U.S. supply, which has been the major source of pressure on crude oil for the last 10 years. So let free markets reign. I fully expect that to happen. It's starting to see it now. Like, all my data shows that we're going to have a glut of supply by this time next year.
Okay, and let's talk a bit about free markets and demand in the US, not just for energy, but just retail demand. We just had the retail sales figures released yesterday, which maybe on their own don't mean too much, but looking healthy. Forecasts for consumer demand still looking pretty good, despite these inflationary prices that we're seeing in the CPI. And those don't include energy and food. So we're talking about other products there. Solid hiring, people can't find labor. I mean, US economy, where is it going next year? What's the projection for that sentiment there?
Our economic team shows it's slowing down, but it's typical. We're in the bounce phase, and now it's coming back. And everything we're seeing is just post-COVID recovery, but it's the normalization process that we should all expect. And that's the key problem with commodities and CPI. You measure it you're going to measure CPI next year from the commodity market, and that from the Bloomberg commodity standpoint, that reached the highest level ever. It's a very high plateau. And commodity traders have been trained to buy low, sell high. And then so you look at the U.S. economy, it's fine, it's doing fine, but total demand for liquid fuel consumption in the U.S. has been the same. It's the same as well as 20 years ago. Now it's starting to go in incremental decline because of efficiency in EVs. So that doesn't really have a lot to do with crude oil price. In fact, it's negative. So to me, these are these big picture things that matter. And a year from now, these kind of things usually mean revert. So macroeconomic, I look at commodities as where I see a potential upside is, and the thing that was really pushed lower this year is gold. And I view most all commodities, and particularly grains, as the key indicator that the supply is coming on, and the U.S. Consumer is doing fine, but by this time next year, they're not going to be doing much better than they are now, because this is just a bounce after COVID.
You mentioned gold. That's certainly had a bounce the last month or so, hasn't it? Up $100. Vladimir, let's talk a little bit about supply chain and trade. Obviously, that's playing into all these prices all the time, whether it's commodities or otherwise. And do you think that the lesson that's been taught this year is that the world needs to shift its trading model, from just in time to something else? Does there need to be more cooperation on these choke points and bottlenecks that we're seeing, whether it's for products, oil, or anything else? And do you see any relief in that market from a shipping perspective next year?
Well, again, I'll see it from the oil shipping perspective, and actually in the oil, you never had a problem. It was the other way around. There was too many ships around. Yes, I know on the container cargo and dry bulk and stuff, it was very difficult to kind of shore up the capacity. I think part of it was that you had this immense slowdown, and then you had a unexpectedly fast rebound. So the system wasn't able to cope with it. Yes, because the system is operating on an efficiency level that is required. And at that time, that was much higher. Here I would agree with Mike. I think we'll coming into a phase of a normalization. The system will kind of get supplied, and then this bottlenecks will actually naturally abate. There will be some additional capacity, but I don't think that the ship owners now going to go and start building large fleets of cargo ships, because at the end of the day, they weren't needed in 2019. Why would they be needed in 2022?
And are you as a supplier, obviously, are you concerned about the wet bulk rates going up this year now that the market is recovering? I mean, it's obviously been a good one.
Yeah. It will go up because they were very low. 2020 freights were very low. So you will see again a normalization. Yes, maybe you will have a spike here and there on the shipping side, because the fleet is getting older, and obviously the last 2 years there weren't much new orders. But equally, what had happened, and I think that probably gonna stay, is you had a much more local trades. Kind of Atlantic Basin grades have stayed in the Atlantic Basin. The arbitrage wasn't really there. There weren't too many kind of long hauls. You still don't have that because of the steep backwardation. So I think the market's going to stabilize at the levels 2019, because again, I don't see why it wouldn't. It's kind of getting back where we were, and there were no humongous rates in 2019. Well, there were spikes, but overall no.
Mike, just to go back to the shale equation, you're confident that it's going to come back in greater volumes. It's already actually ticking up already this year. I don't know where we're at towards the end of November, but you also have companies like Exxon and Shell divesting from that basin as well, and shedding assets there. In terms of the Biden policy towards production, he's come under a lot of criticism, obviously, for dissuading local production and at the same time, obviously, asking other producers around the world. Do you see that shifting in any way, given the pressure now of prices? And do you see shale producers responding to that?
Shale producers will respond based on pure economics, and that is their cost of production is near the lowest ever, about $37 a barrel based on our metrics, and the spread to prices, even in the forward curve, is more than double. And when people mention the majors, I like to point out there is hundreds of independent oil producers in Texas that I just cannot wait to produce oil. And I'm a former farm owner, and when you get the price that's there to produce at good profits, you take your land and you utilize it, and that's what I fully expect to happen. It's purely macro, and it's the case even during the Obama administration. U.S. liquid fuel production was clearly on an upward trajectory, and so we might have gone back to similar policies, but it's the simple supply-demand economics of commodities. And where is the source of incremental supply in the world the last 10 years? It was in shale. It's back there now, and sometimes I get a lot of pushback for being bearish at upper end of the range. Like, if I just look at it as a producer, man, I'd love to be able to lock in these profits there. And that's what I fully expect they're doing.
Okay, I think we've got Rustin Edwards, who can join us now on audio. He doesn't have a camera where he is. He's mobile somewhere. Rustin, can you hear us?
I can, and good morning. And I
Great.
do apologize. I had our own logistics issues here in Switzerland this morning. So
Well, let's talk about that. It's even hitting Switzerland, which is unusual. But yeah, I mean, good to have you, Rustin Edwards from Euronav. Thank you for joining us. We've just been talking a little bit about shipping. We were mentioning it with Vladimir and the supply chain issues in general that are lingering and sort of seem to be lasting through to next year, Rustin. As we approach the end of near the end of the fourth quarter, what are your views on that? Are we seeing any easing on the supply chain logistics?
Well, the slowdown that is happening in Asia is starting to impact on the dry bulk sector. We do see dry bulk rates have come off their highs, and they're probably trending more now to a more, let's call it a mean reversion type level, as raw materials demand has slowed down into China. Conversely with that, tanker freight rates have been moving up higher, which is kind of seasonally in how they trade. Q4, Q1 is usually the strong time for crude oil movements, mainly because of distillate demand, and trying to move distillate-rich crudes to the right locations are usually long-haul prospects. So that seems to be moving in the right direction as well. And container freights, they've come off a little bit from their lofty highs, but they're still going to remain lofty highs because the supply bottlenecks have not eased, and they probably will not ease. And I would be surprised if we had these issues rolling on into Q3 of next year, just because of the scope of the bottleneck and the ulterior factors that are impacting it, such as the lack of being able to find drivers for trucks, which seems to be the biggest bottleneck we have in the world right now.
I mean, and then you mentioned China and raw material demand into there. We didn't see very healthy crude demand in October. What's your outlook for November, December? Are things going to turn around there as we go into the new year?
Well, I mean, demand is picking up slightly on the crude side as well in China. I mean, I think for the raw materials, it's a factor of what are they doing financially inside to keep that demand going. The real estate sector is impinging a lot on iron demand and steel demand because of the issues around Evergrande, which doesn't seem to be going away, seems to be percolating in the background, and probably will continue to percolate until the next shoe drops. But crude demand has been picking up, especially on the long haul side. So we have been seeing more long haul cargoes getting booked. Exports have been increasing incrementally out of the United States, along with U.S. crude production. So that seems to be a good sign for tanker demand going forward. But again, in the winter, a lot of distillate-rich crudes need to move to where they're needed, and that usually means longer hauls.
Okay, we've got our survey question up there for the day. Will U.S.-China talks lead to a recoupling of trade relations? This whole decoupling that was been talked about from a technology point of view, from a physical trade point of view. Rustin, let me go to you that as you've just joined us to make the most of your time with us. What do you make of this sort of, I suppose, hands reaching out to start a détente on economics and trade between the two countries? And do we see any tangible impact on trade, whether it's energy or otherwise, next year as a result?
I think it really is going to depend on how much of the Trump tariffs is Biden able to roll back with China and bring things back to a normalized relationship. I mean, any détente is good, especially with all the rhetoric around Taiwan. And that seems to be the big sticking point. I think we'll see with any U.S. or China relations is how does Taiwan get resolved, or do we just go back to status quo pre-Trump, where Taiwan lives in this realm of a bubble that you can't really talk about, but it's there. So it's good that they're talking. I don't know if we'll see any real tangible results, because you have to have China going on an economic growth to really spur them to be importing in the raw materials. And if they're not having that growth because their economy is slowing down, it's going to make it very difficult. And I think also it doesn't really help alleviate the supply problems in the U.S., because the U.S. supply problems with the container backlogs and what have you are U.S. problems. They need to be solved domestically, not internationally.
And any relief being seen there on the U.S. West Coast in terms of all those ships? And the West Coast has them in terms of China trade.
Well, I think the West Coast gets the headlines because there's so many ships, but the East Coast just has just as bad a problem. And until you can incentivize people to come into the actual sub-support logistics streams of driving trucks to move the containers out of the port, it's hard to alleviate the problem. I mean, it is a question that you've had demand pull, which is basically destocked the inventories on the demand side. You've had supply issues, but the supply has been able to pick up. But you've created this accordion effect where the pinch point becomes the port logistics. I mean, it's almost like you need to have the U.S. take a week's holiday and not buy anything to let all that product clear out. Yes, exactly. I mean, you need to have a shutdown at some point in the supply chain, mainly on the demand side, in order to let the supply chain readjust to the new demand profile.
And perhaps we'll see the natural demand drop in the year ahead or in a few months to allow that to happen. Mike, we've got a few minutes left. Let's look at the rest of the week ahead. Anything that we should be watching out for from an announcement point of view, data, indicators on your radar?
Well, the key thing I'm focusing on is on the macro, and I'm glad we mentioned dry bulk as we were speaking. If you look at the Baltic Freight Index, it's basically plunged from its peak, similar to what it did in 2007 and 8. In terms of the markets, the key thing I'm watching is the macro kicking in for next year, and I'm seeing peaking in crude oil, enduring bear market that's near the upper end of the range, and bottoming in gold, and enduring bull market that's near the bottom end of the range and starting to recover. So to me, that's the macro for commodities, and I see peaks. And then I think we need to rope in China. It's very important to rope in China, partly because they're in secular decline. When they cut their triple R rate, they told us there was a problem. And this has been the trend for the last few years. And now what President Xi is doing is very bad for good open discourse and free markets, which we all know is not good for commodities.
Okay, and what about the outlook for rates? Obviously, it's on the news daily in terms of the rate increase and the inflationary concerns in the US, and whether that's going to really push a rate hike any sooner than the second half of next year or even the end of the year.
It's a dream. I'm dreaming of a rate hike, and all we need is a little bit of wobble in the stock market. And you know what? We all know what's going to happen. The Fed will go right back to easing. The key thing I've been watching is that 30-year long bond. It cannot get above 2%, and that's one of the most significant against consensus trades of the years. Everybody said yields would go up. I look at the enduring trend. It's been down for 40 years. It bumped up to the upper end of the range. And to me, that's a key indicator I'm watching. And that 30-year cannot stay above 2%. To me, it's indicating the deflationary factors are going to kick in next year. And I fully expect by this time next year, we'll be talking more about an inability to sustain higher prices.
Okay, and Vladimir, we'll go to you for the last word. Let's just have a quick look at that result. Will US-China talks lead to a recoupling of trade? No, some pessimism there that anything will change. On that front, 73%. Vladimir, let's just talk about Europe a little bit again on the macro front. And you're in the UK. That's been large. I know it's not specifically an oil-related question to you, but just the sentiment there around where the economies are going. The UK has been dubbed that it would be one of the first in Europe to perhaps increase interest rates incrementally. But just the economic mood in Europe in general, in the UK, and whether that's sort of tracking the US or would it go its own path?
Yeah, I think the picture is very similar. I mean, you have rising prices, you have shortage of labor across Europe. In UK particularly, obviously the truck drivers, as Rustin mentioned, had an impact. So it seems like the economy is roaring, and I think people are feeling it in a sense of wages are going up, buying is going up. If you go out, especially in London, it looks like nothing's happening really. I mean, everything's back, theaters and everything else. So I think for the next quarter or maybe one half a year, I think the sentiment is very good. People are there; they're ready to spend. The industry is
there. Are they taking up the jobs that are being offered? I mean, again, we've had this in the US that all these jobs are on offer and everyone's sitting on their couch at home still watching Netflix. Are we seeing sort of that enthusiasm to take up those opportunities come back?
That's a good question. And to be honest, I don't have the data to answer that. Yeah, I can just see. I mean, the unemployment is decreasing. Particularly in UK, it's a combination of Brexit and the booming economy. But across Europe, you have the same issue everywhere. I mean, you can't find drivers, you can't find people for the factories floors. To a certain degree, I always wonder, where did everybody go? Yeah.
Okay, and Rustin, let's go to you for the last word. December is coming up, last month of the year. Any surprises that you would say could surface there in terms of the trend that we're seeing, whether it's in supply or demand?
Well, I'm putting my line in the sand that I would not be surprised to see U.S. crude production get back to 12 million barrels by December. I think that's a very plausible number to hit with all the rig increases, the DUC increases. Decreases in the DUCs. Production's coming back, and I think it'll come back strong. And I think that will surprise a lot of people in the market how quickly it comes back, or how high it gets up to that level in December. I'm also a bit worried about the watching the Evergrande and Chinese property crisis unfold, because there's a lot of moving parts into that issue, and I think that issue is going to rear its ugly head in December or in January when some of these huge bond payments come due. They're not the $1 million bond payments; they're $1 billion bond payments. And if these real estate companies have trouble meeting those, what is the net impact? Because the rhetoric around the Chinese property issue has become a bit more concerning when you've got the U.S. Treasury Secretary Janet Yellen saying that it may have a knock-on impact into the world economy.
Yeah, of course, the lenders into that property sector are far and wide, aren't they? And many of them are in the US, probably local and global. Obviously, a lot of global lenders into Evergrande and those others that we haven't even heard about. So I suppose everyone's holding tight. Well, thank you very much, gentlemen. We've run out of time. Thank you, Rustin Edwards, for joining us. Vladimir Langhammer and Mike McGlone, have a good rest of your Wednesday and the remainder of the week, and we'll see you soon. Thank you very much.
Thank you. Bye-bye.
Thank you all. Have a good afternoon. Bye.